Hi everyone, I'm Andrew Murphy, Director of Portfolio Management from Winthrop Wealth. We want to wish everybody a Happy New Year, and in today's video, I'll be taking you through some of the key points from our 2019 market recap, as well as our 2020 outlook. The full written version is now available on our website at winthropwealth.com. We look forward to speaking with all of you throughout the year, and if you have any questions, please feel free to reach out to me directly or to anyone at Winthrop Wealth. Let's start with the U.S. equity market and a chart of the S&P 500 over the last year. The market returned 31.5% in 2019, so just a great year. In fact, this was the best calendar year since 2013 and the 16th best overall since 1928. The market reached a new all-time high on December 27th when the S&P hit 3244. And I will point out that a lot of the strong performance in 2019 is partially just a rebound from the sell-off we saw at the end of 2018. So if we take a look at a chart of the S&P from 2018 through 2019, you'll notice that big decline toward the end of 2018 where the market nearly fell into bear market territory with a decline of close to 20%. It experienced the worst December monthly return since 1931 with a drop of 9%, and it posted its first calendar year loss since 2008 with a decline of 4.4%. So if we go back to 2019, there is an old investment adage that the stock market climbs a wall of worry. And yet, at the start of the year, you would have received some pretty funny looks if you would have predicted the market would return over 30% despite the yield curve inverting, the US and China still negotiating a trade deal where both sides implemented new tariffs, the ISM manufacturing measure falling to contraction territory, the S&P in the midst of an earnings recession with 3 consecutive quarters of negative annualized growth, and the House voting to impeach President Trump. Yet, that is exactly what happened. So why is the market back to all-time highs after returning 31.5% in 2019? Well, in my opinion, there are 2 major reasons for the market rally this year. The first is the Fed pivot to accommodative monetary policy, and the second is some progress toward a US-China trade deal. Now we'll look at current Federal Reserve policy. So this chart shows the upper end of the federal funds rate in the top panel, and the Fed funds rate is actually a range of 25 basis points. So right now it stands at 1.5 to 1.75%. So again, this shows the upper end of that range. And the bottom panel shows the current size of the Fed balance sheet in trillions. So right now that stands at about 4.2 trillion. And with this chart, you can see the shift in policy that took place throughout the year. In 2018, the Fed raised rates 4 times, and they did not even want to discuss the possibility of altering their policy of shrinking the balance sheet. And at the end of 2018 is when Chairman Powell infamously stated that the balance sheet runoff policy is on automatic pilot. And at the time, essentially, the Fed's plan was to continue to put upward pressure on both short and long-term interest rates. And we know that in 2019, the Fed completely reversed course and ended up cutting the federal funds rate 3 times, increasing the size of their balance sheet, and they also suggested a high bar for future rate increases. And that last point is critically important. So regarding future interest rate moves, Chairman Powell stated that he would want to see persistent and significant increases in inflation before raising interest rates. And given that inflation readings have been consistently below the Fed's 2% target for the last decade, and the latest reading was around 1.6%, right now it seems unlikely that the Fed will increase rates in 2020. So again, the move to accommodative monetary policy provided a boost to risk assets, including stocks, throughout the year, and it should continue to do so for as long as the Fed maintains its current view. With that, let's move to the other major issue impacting the markets, and one that has been on the front page of financial news for about the last 2 years, the US-China trade war. We actually got some good news toward the end of the year as the two sides were able to agree to a phase one deal. And that agreement is currently scheduled to be signed at the White House on January 15th. And while the document has not yet been made public, here's what we know so far. The US agreed not to implement the December 15th tariffs on 160 billion worth of consumer goods and electronics, and also to roll back the existing tariff rate on 110 billion worth of products from 15% to 7.5%. China, for its part, agreed to increase its total purchases of US goods, including agricultural products, and also agreed to end its policy of forcing foreign companies to transfer their proprietary technology to Chinese companies as a condition for receiving market access. And this forced technology transfer, in our view, is the most complicated and important aspect of the trade deal. So while it's nice that it was included as part of the phase one agreement, from here, we'll have to see if China does indeed live up to their commitments. And last, the two sides were able to agree to an enforcement mechanism where tariffs could be reinstated if complaints are not resolved. And again, this is also important as the threat of new tariffs may remain even after a full agreement is signed. Phase two negotiations are supposed to begin immediately, and they will attempt to address several issues, including Chinese subsidies to state-owned firms, digital trade, currency manipulation, and cyber theft. We're viewing the phase one agreement as positive, as it does avoid the worst case scenario of a full-blown trade war, and it does remove some of the uncertainty associated with current and future tariffs. However, the trade war will remain a drag on the global economy and will remain as our top market risk until a comprehensive agreement is signed and more tariffs are eliminated. And as you can see from our tariff scoreboard here, the US still has 7.5 to 25% tariff rates on about 360 billion worth of Chinese imports, while China still has 5 to 25% tariff rates on 110 billion worth of US imports. Now I want to highlight what happened in the US fixed income markets. So this chart shows the 10-year Treasury yield in green and the Bloomberg Barclays Aggregate Bond Index, or the AG, in red. And the AG really acts as a proxy for the investment grade bond market. As you can see, bond prices move inversely to yields, and the drop in interest rates was positive for the fixed income markets. So in 2019, the 10-year Treasury yield decreased from 2.68% to 1.92%, while the AG increased by 8.7%. I'll also highlight a few things. First, that the 10-year Treasury yield of about 1.9% is certainly low by historical standards, and interest rates are low in the US for a few reasons, including low global interest rates. So government bond yields in Germany and Japan both ended the year negative, and also for low expectations of future inflation and economic growth. And last, at Winthrop Wealth, fixed income plays three roles in diversified portfolios: ballast, stability, and income. We went into this in great detail in our November client question of the month, which you can find on our website. I also want to quickly cover the current shape of the Treasury yield curve. So this chart shows the various yields and maturities for Treasury bonds ranging from 3 months to 30 years. And the solid orange line is the current shape of the yield curve, while the dashed line is what it looked like in late August. So as you can see, in late August, the curve was considered inverted, with short-term yields higher than long-term yields. And throughout the year, after the Fed cut rates 3 times, the yield curve uninverted to the more typical normal shape that it is now. The yield curve is a critical economic indicator. It's one that we follow very closely. And we also covered the yield curve and the implications of an inversion in our March client question of the month, which again is available on our website if you'd like more details and information. And last, let's move to our outlook for the US equity market. As we move into 2020, we are staying with our balanced outlook, meaning we're keeping our client allocations fairly close to their target levels as we continue to weigh the impacts of accommodative monetary policy from the Fed, which is positive, and the economic drag caused by the US-China trade war, which is obviously negative. Now, throughout the year, we did defensively shift portfolios as the market increased and valuations became stretched. So we were able to participate in the market upswing without taking on excess risk while maintaining a relative level of downside protection. Our market outlook is based on 4 categories: economic growth, central bank policy, market fundamentals, and market valuation. Now, the issue in the current environment is that the trade war impacts each category. So our view remains that the Trump administration is simultaneously hitting the gas and the brake on the stock market and the economy. The gas is the lower individual and corporate tax rates, deregulation, high government spending, and low interest rates from the Fed, which are supporting a strong labor market and consumer. The brake is the trade war and tariffs, which are leading to manufacturing sector weakness and business uncertainty. Now, we would expect President Trump to take his foot off the brake this year because any type of economic or market weakness would obviously not help his reelection chances. However, we do want to be mindful and prepared for the potential tail risk if President Trump does indeed decide to ramp up the trade war with new tariffs or raise the rate on existing tariffs, which could lead to a market sell-off or potentially a recession. So putting it all together, having a balanced outlook and maintaining flexibility is critically important. As always, we will continue to opportunistically incorporate new market developments as part of our total net worth approach to comprehensive financial planning and investment management. Again, if you have any questions, you can reach out to me directly or to anyone at Winthrop Wealth. And also, please look for our January market recap and client question of the month, which should be mailed out and available on our website in early February.